The investor community is also adding its reaction to these developments. Luigi Marinus from PPS speaks to us now. Good evening to you, Luigi. Do talk us through what this decision now means for investors and investment, as it is the 6th consecutive time that the MPC has decided to leave rates unchanged.
Good evening to Misang. It wasn't a surprise. I mean, like you said, it's the 6th consecutive time now that it was unchanged. And I think, as we know, with the kind of unofficial level of the inflation rate that the Reserve Bank is targeting of 4.5%, we were well above that in the last inflation print. So not a major surprise that interest rates were not reduced this time. From an investment perspective, I mean, there are opportunities that do arise, especially from a fixed interest perspective. If you look at, for example, our cash fund or that are low risk kind of in investments, we're currently earning about 9.7% on a 12-month forward basis, and so there's good opportunities in that, and it comes with very little risk indeed. I think when people think from an investment perspective and they think about interest rates coming down, they think of the opportunities for equities, and there's no doubt that equities, however, have come under some difficulty as the market's kind of been waiting for interest rates to come down. But if you have a well-diversified portfolio, there's always parts of a portfolio that can take advantage of different market conditions, and we're certainly able to do that.
Having said that, what then becomes the near-term outlook for the investor community where interest rates are concerned? We are likely to be in a high interest rate environment for a little longer than what was initially anticipated.
Most certainly. We saw that at the end of 2023 when the market started speculating quite strongly that firstly the US Federal Reserve was going to start reducing interest rates, and we saw the positive impact that had on riskier asset classes, and we were able to take advantage of that. In the start of 2024, however, we started to see that inflation was stickier than was previously anticipated, and the rhetoric definitely changed, or the narrative changed in terms of what central banks across the world were talking about then, becoming a lot more cautious. I think the worst case scenario for central bankers after having a period of very high inflation is to start cutting rates too early, and then starting to see inflation coming back. So they're definitely wanting to be quite careful around that. And that has meant that we've had periods of riskier assets, global equities or local equities going through strong periods, but then also we've seen it pulling back at some points as well. In South Africa, of course, our equities are relatively cheap. And an argument can be made that there's a reason why it is cheap, but cheap asset prices does give you an opportunity in the future. We probably are of the opinion that it's the right call to be what we'd say cautiously optimistic at the moment. So there's some dry powder to maybe take advantage going forward, but maybe right now is not the time to pull the trigger yet.
As a passing shot, though, what picture is painted of the investment community across the globe, given the world economic challenges as well as elevated interest rates across the world with regards to the current economic climate?
Yeah, I mean, that is the topical question at the moment, and I think what people realize is that for quite a while, when inflation was low globally, we almost forgot about inflation. And now when inflation increases again, we start to realize again how much that potentially can hurt. We've had a bit of a kind of difference from the US in particular, as far as global equities have been concerned, mainly as a result of seven stocks, and it's been kind of called the Magnificent Seven. It's been large tech companies that have done particularly well, and almost surprisingly well in how good the returns have been for those companies. Very well-known big companies that we've all heard about, and they've kind of skewed the market in a sense. So if you take away the returns of those seven companies, we might see that the returns actually haven't been that good. So if you were in that portion of the market and were able to take advantage of that, you've performed quite well. And we've had parts of our portfolios, for example, that have been there. Other parts of the portfolio, though, and I think investments in general have been a bit more cautious, considering the perspective that what if the market is wrong and what if interest rates actually start decreasing a bit later than previously envisaged. And that is how it has played out. And like I mentioned earlier, the big opportunity actually has been in the less risky asset classes like cash, for example, that's giving you a almost risk-free return of close to 10% in South Africa. And so if you've had allocations to those portions of the market, you could still get handsome returns. And that's also well above inflation as well. Like we said, inflation printed at 5.6% for February. So if you're earning close to 10%, that's inflation plus 4% at very low risk as well. And so again, there are opportunities in the market and opportunities in South Africa as well.
Thank you so much for your insights. Luigi Marinus is with PPS talking to us about the reaction of the investment community with regards to the latest outcomes of the Monetary Policy Committee meeting.